In order to understand the 2008 financial crisis, it's important for us to be able to wrap our heads around a particular kind of security that was absolutely instrumental in leading to this rather spectacular crash. And these are securitizations. Securitizations are very similar to what we described a couple of videos ago when we were looking at Chinese wealth management products. They're effectively a portfolio of loans that has been repackaged and sold off to other investors. In this way, the initiators of various kinds of loans, like student loans or credit card loans or auto loans, can acquire the capital from investors to be able to finance these loans without necessarily having to hold them on their own balance sheets. Effectively, what you have are companies that initiate things like auto loans, and then they resell these auto loans to other organizations, which will take these various debts, blend them together into diversified portfolios, and then write bonds whose cash flows are expected to be derived from these kinds of portfolios. Now, this is not a particularly new innovation, right? We've been making securitizations out of mortgages, for instance, since 1971 in the US and since 1986 in Canada. We tend to blend up a number of different kinds of risk-based securities. This way, we're able to repackage effectively consumer debts and commercial debts in a way that is more palatable for investors. The way that this is done, of course, is by setting up what's called a special investment vehicle, where the originator sells off various kinds of loans to a specifically created company that buys these assets and pays the originator in cash. But where does the cash come from at the SIV? Well, ultimately, these SIVs are going to sell securities backed by these assets to an investor. And the investors are going to supply the cash to the SIV, who will then supply it to the originator. And as payments are made on these individual loans, that money is passed uphill to the SIV, who inevitably passes it back on to the bond investors who've purchased these securitizations. In order to ensure safety for bond investors, these types of SIVs are usually over-collateralized, meaning if they're expected to, say, produce $100 every month worth of cash flow for investors, they're typically backed by $103 or $105 or maybe even $110 worth of expected payments from these loans, thereby enabling a portfolio which does not have a perfect default record to effectively back a portfolio which might have a perfect record regarding defaults. So another significant improvement in terms of the overall credit of these assets that underlie these securitizations, one of the things we frequently see is that the issuers, the special investment vehicles, will buy what's called a credit default swap, effectively requiring some third party or fourth party in this situation to absorb any losses that might occur should the original underlying loans fail to make their payments to the SIV. Now, of course, this is contingent on whoever happens to have sold this credit default swap actually being able to and willing to meet their obligations. Now, the securitization of mortgages, as you probably know, played a major role in the panic of 2008, which ultimately unleashed a global financial crisis. Interestingly enough, though, we didn't have the same kinds of complications in Canada that our American cousins did, mostly because of the structure of our banking system and the extent to which we engaged in the securitization of mortgages in the private sector. What's the distinguishing features about Canadian banking that differs from American banking is the notion of branching. We think of it in Canada as being perfectly normal for us to have branches across the country of a single institution, but this is just not all that common in America, except for its large national level banks. And this meant, of course, that defaults in one particular area were able to diversify across the entire country and organization, as opposed to necessarily being concentrated in a single neighborhood or a single town where a small unit bank might write all of its businesses. An important thing to consider as well is that roughly only 10% of Canadian mortgages were being securitized back in 2000, where roughly 60% of US mortgages were being securitized. So this was a much more common structure in America than there was in Canada, and its institutional investors tended to be much more receptive to the idea of buying a securitized mortgage-backed product. Now, overall, the idea behind securitizing a mortgage is not necessarily a problem. However, there was a problem with how things were ultimately designed in terms of the incentives for various people along the value chain. For instance, originators in the United States were incentivized purely to write a lot of business. Since they weren't being required to hold any of the mortgages they were writing on their own balance sheets, they didn't actually absorb any of the risk of a bad underwrite. Instead, that risk was passed along entirely to investors in the underlying asset-backed securities. So how do we estimate the kinds of risk that an investor in these kinds of mortgage-backed securities actually faces? Well, traditionally speaking, these kinds of mortgages were only securitized by very large government-backed institutions, which carried government guarantees in case something went wrong. And this was seen as an effective backstop for securitized mortgages, which had otherwise complex risk profiles that were hard to necessarily navigate. But back in the early 2000s, there was an MIT professor, David Lee, who came up with a particularly clever approach to resolving the math challenges that underlay the securitization of mortgages. And the short version of the story is that Lee's efforts ultimately relied on a particular assumption, the assumption that the market for credit default swaps and the prices on those credit default swaps accurately reflected the risks that investors in those underlying assets ultimately faced. Now, this may very well have not been the truth, but using this assumption, David Lee was able to come up with a relatively clever and simple, and importantly, tractable model, which enabled people to drastically simplify the estimates of the kinds of risk that a portfolio of mortgages faces. Now, the reason a portfolio of mortgages faces different kinds of risks than we might see in a portfolio of, say, student loans or auto loans ultimately comes down to contagion effects. If I default on my student loans, this in no way influences anyone else's probability of defaulting on their student loans. But this is not the case with mortgages, particularly if mortgages that have been bundled into a portfolio are all based in the same areas. Because in the real estate market, if my house suddenly sells for 20% less than its market price, this has an impact on the market price of all of the other houses in my neighborhood. So follow this example. Let's say that we all in the same cul-de-sac live together, and I have taken out a loan from my bank in order to secure my mortgage. But ultimately, the price of my house suddenly falls below the value of my mortgage. I borrowed $900,000 to buy a house, but now the value of the house has fallen to $800,000. In the United States, borrowers are largely able to simply return their keys to the bank and walk away from their debt. This is not quite the case in Canada, where borrowers are simply held on the hook for the full amount, regardless of what happens to the value of their underlying property. Nonetheless, in America, because it's fairly easy to walk away from a mortgage which has gone underwater, what we typically saw is when housing prices began to fall, people simply turned their keys into the bank. Now, banks aren't interested in holding on to residential properties for the most part and typically sell them at fire sale prices below the market price. So what happens when the bank forecloses on my mortgage and sells off my house in the cul-de-sac for lower than the value of your houses? All of the prices of your houses drop. And this makes things particularly problematic. Once again, if I default on my student loan, it doesn't encourage anyone else to default. But if I default on my mortgage and the bank seizes my house and sells it for under market price, this can affect the price of your asset and therefore affect your probability of defaulting on your mortgage. And this was the major issue with securitizing mortgages in the private sector. But with David Lee's Gaussian copula function, this suddenly became a possibility for independent organizations and investment banks to simply buy up these kinds of mortgages and securitize them themselves rather than relying on government organizations like Fannie Mae and Freddie Mac to do it for them. Now, of course, there were warnings about the limitations of David Lee's model, but very few people had the technical skill to even understand what a Gaussian copula was, let alone the capacity to start to question the assumptions that underlie the model. And so despite warning people about the limitations of this model, what we saw is that it was widely embraced by just about everyone. And as a result of this sort of wide embrace, what we saw very quickly with people who began to try to game these particular systems to extract as much value as they thought they could, while leaving the risk to be dealt with entirely by those who were ensuring there is mortgage-backed portfolios.